All right, so chapter 5. So chapter 4, we talked about merchandising companies. In chapter 5, we're going to talk about how we report and analyze inventories. So here are our learning objectives for chapter 5. So we're going to talk about what makes up merchandise inventory, identify the costs of merchandise inventory, analyze the different inventory methods and errors, and then we'll compute inventory using a periodic system with the various methods of inventory costing. All right, so let's identify the items that make up merchandise inventory. So it includes all goods that a company owns and holds for sale, and it doesn't matter where those goods are located, okay? So goods in transit. So we talked last chapter about FOB shipping point and FOB destination point. If goods are shipped FOB shipping point, they're included in the buyer's inventory when they're shipped. If they're shipped FOB destination, they are not included in the buyer's inventory until they arrive. Goods on consignment. So a consignor is the owner of the goods. The consignee is the person that's selling the goods for the owner. So merchandise is included in the inventory of the consignor, the owner of the goods. The consignee never reports consigned goods in their inventory. Okay. All right, damaged goods or obsolete goods. So damaged or obsolete goods are not reported in inventory if they cannot be sold. Damaged or obsolete goods which can be sold are included in inventory at their net realizable value, which is defined as the sales price minus the selling costs. And then loss is recorded when obsolete or damaged goods are discovered. Okay? All right, costs of merchandise inventory. So determining the inventory cost. So it's all necessary expenditures to bring an item to its saleable condition and location. So your inventory cost is basically equal to invoice costs less any discounts plus any incidental costs. So incidental costs are things like shipping, storage, insurance. Okay. All right, so some internal controls and physical counts of inventory. Most companies take a physical count of inventory at least once a year. When the physical count does not match the merchandise inventory account, an adjustment must be made. Typical controls over inventory counts include the following. Pre-numbered tickets. The counters have no inventory responsibilities. The counters confirm the existence, the amount, and the quality of the inventory item. And a second count is taken by a different counter, and then the manager typically confirms all the items counted only once. Okay? All right, so need to know, number 1, master carver of wooden birds operates her business out of a garage. At the end of the current period, the carver has 17 units in her garage, 3 of which are damaged by water and cannot be sold. The distributor has another 5 in her truck ready to be delivered per customer order. Terms FOB destination. And another 11 units out on consignments at several small retail stores. How many units does the carver include in the business's period end inventory? All right, well, so we've got 17 units in the garage, but 3 are damaged. So 17 less 3, plus the 5 that are in transit because it's FOB destination. So the 5 in transit don't get removed from the inventory until they reach the destination. And then the 11 units that are on consignments are also part of the wooden carver's inventory. So the total units in ending inventory would be 30. Okay. All right, so then in the second one, a distributor of artistic iron-based fixtures acquires a piece for $1,000 FOB shipping point. Additional costs obtaining it and offering it for sale include $150 for transportation in, $300 for import duty, $100 for insurance, $200 for advertising, $50 for voluntary gratuity, $75 for store lighting, and $250 for sales staff salaries. With respect to computing the cost of the inventory, what do we include and what do we not? So the acquisition is $1,000, so we include that, right? The transportation in of $150, we would include that as well. The $300 for import duties, we would include that. The insurance we would include as well. But the advertising, gratuity, store lighting, and sales staff, nope, not part of inventory. Okay, so we've got cost of $1,000, transportation in of $150, import $300, insurance $100 for a total inventory cost of $1,550. Okay, so when identical items are purchased at different costs, we must determine which amounts to record in cost of goods sold and which amounts to remain in ending inventory. And so we do that with a cost flow assumption, but the important thing to note is that the physical flow does not need to match the cost flow. So there's 4 inventory costing methods. The first is specific identification. Then there's this idea of first in, last out, or FIFO, last in, first out, or LIFO, and then weighted average. Okay, what they're trying to show you here is just like a pictorial view of the uh, inventory cost flow assumptions. And so under the first one there, first in, first out, cost flow in the order incurred. So like the May 1st purchase, the bottom purple box, they paid $45. The May 3rd, they paid $65, and the May 6th, they paid $70. And so the first costs to flow through cost of goods sold are going to be the oldest purchases, or the first purchases, in this case May 1st. And then your ending inventory is comprised of the costs from the May 3rd and the May 6th purchase. Whereas in number 2, the last in first out method, the last or the most recent purchase, the May 6th, those costs are going to be the first that go to cost of goods sold. And then your older purchases, your May 1st and your May 3rd, are the costs that are being used to value your inventory. And then weighted average, the costs flow at an average of the costs available. And so what happens is you average all of the purchases during the period, and you take the average cost times the number of units, and that's what's flowing through your cost of goods sold. But the same is sitting in your ending inventory. So essentially, you have $60 per unit in this case, and your cost of goods sold is going to show 60 for the 1 unit they sold, and then the 2 units that remained in any inventory are going to be at $60 each as well. Okay, I think when we get into some examples, it'll start to make a little bit more sense. Okay, so the cost flow of inventory. So beginning inventory plus net purchases equals merchandise available for sale. And then merchandise available for sale goes one of 2 places. Either it's still in your ending inventory, or it's flowing through your income statement in cost of goods sold. Okay. All right, so now let's look at we'll go through some examples, computing inventory using the periodic system, and then the various methods of cost flow. Okay, so this is a chart of information that they're going to use in the next several examples. The aim, basically, there's 2 cost systems. There's inventory systems. There's periodic and perpetual. And the aim of both of them is to assign cost to inventory and assign cost to cost of goods sold. The same 4 methods are used under both systems. The results will be the same in both a periodic and perpetual system when we use specific identification or FIFO. Under the LIFO and the weighted average, they will be different for the periodic and the perpetual systems. So, and we'll get there. I realize I'm talking Spanish at the minute, but we'll define all of these terms. So the inventory costing periodic system. So on August 1st, they had some inventory. They started with 10 units at $91. On the 3rd, they bought some units, 15, at $106. On August 14th, they had a sale, 20 units at $130 sale price. Then they purchased 20 more units on August 17th, 10 more units on August 28th, and then they sold 23 units on August 30th. So there was 55 units for sale at a cost of $5,990, which is just the sum of the 910, 1590, 2300, and 1190. They sold 43 units at retail price, and the number of units that are left in ending inventory are 12. So, if we are using the specific identification method, we had the 55 units available for sale at the $5,990. They sold 14 units, or I'm sorry, they sold 8 units on August 14th at $91, and they also sold 12 units at $106. So 8 times 91 plus 12 times 106, that's $2,000. Then they sold additional units on August 30th. So there were 2 remaining at 91. There were 3 remaining at 106, and then they sold all 15 at 115, and 3 of the units purchased at the cost of 119. So we've got cost of goods sold of 2,582 plus 2,000, total cost of goods sold 4,582. So 5,990 available for sale. We said that the available for sale go one of 2 places, either to ending inventory or they stay in, or either to cost of goods sold or they stay in an ending inventory. And so you just take the 5,990 less the 4,582 for an ending inventory balance of 1,408. Okay? Specific identification is probably the simplest because they tell you what units they've sold, what the cost was for those units. Okay, so here's all the entries that are used to record the purchases and sales that were on that very first slide that they said we were going to use for the subsequent slides or subsequent examples. Really what they're trying to show you here is that that last entry. So the numbers that are in red were determined using the specific identification method. And under the periodic inventory system, the purchases account is debited when purchases are made. And then at the end of the month, the merchandise inventory account is debited for the amount of ending inventory. So it's like under the periodic system, the purchases account is almost like a temporary account. And at the end of every period, you close that out like you do an income statement account to the income summary. So at the very end of the month, we're going to debit merchandise inventory for the amount of ending inventory, which is 1,408, and then it's going to be credited for the amount of the beginning inventory, and the income summary is credited for the difference. Okay. All right, so under the inventory costing system, FIFO, we had the 5,990 available for sale. And if we're subtracting our ending inventory, which is priced using FIFO, the FIFO method means that the earliest cost, or the cost of the earliest purchases, is the cost that's going to flow through cost of goods sold first. So that means your ending inventory is at the most recent purchase cost. So that's why we have 10 units left from the August 28th purchase at 119. And then we have 2 units left from the August 17th purchase at 115. So our ending inventory would be valued at the most recent cost because our cost of goods sold is the first cost. So our cost of goods sold is $4,570. Okay. And then under LIFO, we're assuming that the very first purchases are those that are sitting in ending inventory. So we have 12 units total left. So we're going to use the 10 units from the August 1st beginning inventory at the $91 and the 2 units from the August 3rd purchase at 106. Okay. All right, and then weighted average. Every time a unit's sold, the average cost of each unit in inventory is assigned to cost of goods sold. So step 1 is to figure out how many units we have. So that's 10 units at 91, 15 at 106, 20 at 115, and 10 at 119. So we have 55 total units at a total cost of $5,990. Then we figure out what the average cost is per unit. Divide 5,990 by 55, and you get $108.91. Our ending inventory is 12 units. Our cost of goods sold is 43 units. We had 55 to start, less 43 equals 12. So 12 units at 108.91 per unit makes our ending inventory 1,307. And our cost of goods sold, 43 units at 108.91 per unit. Cost of goods sold is 4,683. Okay. All right, so let's look at the effects the inventory methods have on financial and tax reporting. So what they're trying to show here is that when purchase costs are regularly on the rise, FIFO is going to report the lowest cost in cost of goods sold, yielding the highest gross profit and net income. LIFO is going to report the highest cost of goods sold, yielding the lowest gross profit and net income. And then the contrary would be true in periods of decreasing costs. Okay. All right, so all four costing methods are acceptable, but the company has to pick one, and then they have to disclose which one they're using in their financial statements or the notes to their financial statements. So FIFO would report an amount to inventory on the balance sheet that does approximate its current cost, and it also mimics the actual flow of goods for most businesses. LIFO would report the cost of goods sold on the income statement that approximates current cost. And it also better matches current costs with revenues in comparing gross profit. And then weighted average just smooths out the price changes of your inventory. Okay. All right, so companies can and often do use different costing methods for financial reporting and tax reporting. The only exception is that if you use LIFO for tax reporting, because if prices are continuing to be on the rise and your latest purchases is what's going to flow through your cost of goods sold first, that means your gross profit's going to be the lowest. And therefore your tax will also be low. If you choose LIFO for tax reporting, the IRS does require it to be used in the financial statements as well. It's called the LIFO conformity rule. Okay. All right, so let's see if we can work through some examples and hopefully this will start to make some sense. So, company uses a periodic inventory system. Determine the cost assigned to ending inventory and cost of goods sold using all four of the methods. So for specific identification, the ending inventory consists of 10 units, where 8 are from December 30th and 2 are from December 8th. All right. So no matter what method we use, we should have 26 units in cost of goods sold and 10 in ending inventory. Okay. So we have 36 to start right here, and we sold 26. All right, so let's do specific identification first. So under the specific identification method, actual cost of goods sold represent the actual cost of the units that were selected by the customer. So think like vehicles, motorcycles, like large purchases, like houses, purchases like that, okay? All right. So under the specific identification, the cost of the exact units sold or expensed as cost of goods sold. So I think that's what they want us to do here first. So, oh, I thought those were going to come in periodically. Here's how it goes. So under specific identification, they're saying that the units that are assumed to be left in ending inventory are 8 from December 30th and 2 from December 8th. So our ending inventory has 2 from the December 8th purchase, and those were purchased at $4.50 a unit. So there's $9 there. And then they have 8 from the December 30th purchase. And the December 30th purchase was $5.30 each. So 8 times 530 is $42.40. So they tell you what should be in your ending inventory. And then everything else goes to your cost of goods sold. Okay? So all 5 of your units at 3, all 8 at, or 8 of your 10 at $4.50, all 13 at $5. And so you take the unit times the price to get the total of that. And then you add up the totals and add up the units, and that's your cost of goods sold. Okay? All right, so now using FIFO, the first items are the first items in are the first items expense to cost of goods sold. So we sold 26 units, so our cost of goods sold is going to be all 5 of the first one of the beginning inventory, all 10 of the December 8th purchase, and then 11 because we need to get to 26. So 11, 15 plus 11 is 26. So 11 of our 13 at $5 are going to be sold. And then what remains is the last 2 from the December 13th purchase or 19th purchase, and the last 8 from the December 30th purchase. So first in, first out, everything goes through cost of goods sold until you get to 26 units. So we have 5, 10 plus 11, it's 26 units. And then what's left is our most recent purchases, all 8 from December 30th and the last 2 from December 19th. Okay. All right, under LIFO, the last items in are the first items out. So all 8 from December 30th are sold. All 13 from December 19th are sold. 8 and 13 is 21, so then we only need 5 to get to 26 from the December 8th purchase. 5 times 4, 50, 13 times 5, 8 times 5, 30. Add them up, $129.90 is what's going through your cost of goods sold. And then what remains in ending inventory are your oldest costs. So you have all 5 from your December 1st beginning inventory, and then you have the other 5 from your December 8th purchase that remain in ending inventory for a total of 10 units at $37.50. Okay, is it starting to make sense? All right, and then under weighted average, cost of goods sold is calculated at the end of the period. So each unit sold and each unit in ending inventory is assigned the same cost per unit. So if we take 136 units, or I'm sorry, $167.40 divided by 36 units, it's an average cost of $4.65 per unit. So you have 26 units in your cost of goods sold at $4.65 or $120, and you have 10 units left in your ending inventory at $4.65 or $46.50. Okay? All right, so let's talk about the lower of cost or market. So your inventory is required to be reported at market value when market value is lower than cost. So it's defined as current or replacement cost, not sales price. So you can apply the lower of cost or market to each individual item separately, to major classes of assets, or to the whole inventory. So if a motorsports retailer has the following items in inventory, they've got Roadster and Sprint, 20 and 10 units. The total cost is $220,000, $170 for these guys and $50 for these guys. The market is $140 and $60. So if we're reporting the Roadster at the lower of cost or market, market's the lower one, so we need to report that at $140. And the lower of cost or market for Sprint, cost is the lower one, so that's $50. So what has to happen is when we're adjusting our lower of cost or market items, our inventory is recorded at cost. And so if our market's 140, we have to reduce our inventory to the market value. And so the way we do that is just a debit to cost of goods sold and a credit to merchandise inventory. Okay? All right. So a company has the following products in its ending inventory. Compute the lower of cost or market for its inventory when applied separately to each product. And then if the lower of cost or market is less than the recorded cost of inventory, record the adjustment. So for the road bikes, we have a cost of 1,000, market of 800. We're going to have to write that one down to market, right? So 5 units times 1,000 is 5,000. 5 units times 800 is 4,000. We're going to have to write that one down to $4,000. So mountain bikes, total cost is 2. Market is 24, so 2 is fine. And then the town bikes, the cost is 4,000, the market is 4,500, so our cost is also fine on that one. So the only one that we have to write down is this first guy. So the way that we do that is a debit to cost of goods sold and a credit to merchandise inventory for $1,000, which is the difference between the cost of 5 and the market of 4. Easy peasy. All right, so analyzing the effect of inventory errors on current and future financial statements. Okay, so this slide is showing the effect of inventory errors on key amounts in the current and the next period's income statement. So in row 1, year 1, understating the ending inventory overstates cost of goods sold. And the reason why is because remember how we said merchandise available for sale went one of two places, either to cost of goods sold or ending inventory. So if one is overstated, the other is understated, and vice versa, okay? And because cost of goods sold is overstated, net income is going to be understated because you've reported more expenses than you should have, okay? And then in year 2, understating the ending inventory for year 1 becomes an understated beginning inventory for year 2. So if beginning inventory is understated, cost of goods sold is understated because we're starting with a smaller amount. And then a lower cost of goods sold would yield a higher income. Okay, so the error flips in year 2, basically. In row 2, year 1, overstating ending inventory understates cost of goods sold, and a lower cost of goods sold would yield a higher income. Okay, and then in year 2, the contrary is true, right? It reverses. So because our overstated ending inventory for year 1 becomes an overstated ending inventory for year 2. So if beginning inventory is overstated, then cost of goods sold is understated, and therefore a higher cost of goods sold yields lower net income. Okay, this is one of those you're probably going to have to study for more than just a few minutes to make sense of it, but I would bookmark this slide, and if nothing else, just memorize those first 2 rows, okay? All right, and so understating ending inventory understates both your current assets and your total assets. And then an understatement to ending inventory also yields an understatement to equity because the understatement to net income, which is driven by the overstatement of cost of goods sold. So if ending inventory is understated, cost of goods sold is overstated, which means net income is understated, and therefore equity is also understated. Okay? And then the contrary would be true. So this might be another slide that if nothing else, you just memorize. Or study it or replay it back a couple times and see if it makes sense. Okay, so a company had $10,000 of sales in each of the 3 consecutive years, 01 to 03. It purchased merchandise costing $7,000 in those years, maintained a $2,000 physical inventory from the beginning to the end of that 3-year period. So in accounting for inventory, it made an error at the end of the year 01 that caused its end of the year 01 inventory to appear on its statements as $1,600 rather than $2,000. So determine the correct amount of the company's gross profit in each of the years and then prepare comparative income statements showing the effect of the error on the company's cost of goods sold and gross profit for each of the years. So our correct amounts are $10,000 in sales, $2,000 beginning inventory, cost of goods sold is $7,000, which makes goods available for sale equal to 9, and then ending inventory of 2,000, because they told you beginning and end were the same. So we have cost of goods sold of 7 for gross profit of 3. Okay, so in year 2, the same is true. In year 3, the same is true as well. They tell us that. Okay, so if we look at the inventory error, this $1,600, where's my pen? This $1,600 in ending inventory is what they told you they booked when they should have booked 2,000. Okay, so in year 2, they've got it correct, and in year 3, they have it correct. And so let's see, prepare the income statement showing the effect of the error. Okay, so the effect of the error on gross profit is we understated gross profit by $400, but in the next year we overstate it by $400, right? And in the last year, everything's corrected. So at the end of the 3-year period, we get to the same answer. It's just the inventory error in year 1 flips in year 2, and then cumulatively, you're correct. Okay, does that make sense? All right, assess inventory management in both inventory turnover and days sales. Inventory turnover shows how many times a company turns its inventory over a certain period. So it's basically an indicator of how well management is controlling the amount of inventory available. The thing about it is that you don't want to tie up a bunch of your cash in inventory that's not selling quickly, because you could be doing better things with that cash. Okay? So the way that it's computed is cost of goods sold divided by average inventory. Average inventory is beginning inventory plus ending inventory divided by 2. Okay? Days sales and inventory basically tells how much inventory is available in terms of the number of days sales. So if you take ending inventory divided by cost of goods sold times 365, it'll tell you how many days sales are in inventory. Okay, it's often viewed as a measure of the buffer against out of stock inventory. Okay, and it's useful in evaluating the liquidity of inventory as well. Okay. All right, if we look at an analysis of inventory management, merchandisers plan to control inventory purchases and sales. Toys R Us turnover and days sales and inventory are shown below. So inventory turnover, it's turning over 3.5 times in 16, 3.7 times in 15, 3.7 times in 14, and 3.9 times in 13. And so what's fascinating about this, I don't know if you guys know this or if it's all over the country, but I know the Toys R Us by Us closed. And I'm wondering if it, I mean, I'm sure it had to do with a lot of different things, but you see the decline in their inventory turnover? Not a good sign, right? And then compared to the industry, see they're quite a bit higher than the industry too. So industry average in 2016 was 3.3 times, so they were a little bit higher than that. In fact, every year they were higher than the industry. So, and then the same thing, days sales and inventory. So 109, 95, 97, and 95 days compared to 130, 126, 129, and 132. So, we prefer inventory turnover to be high, but then the days sales and inventory suggest that, the management needs to increase inventory turnover and reduce their inventory levels. The inventory buffer seems a little bit too high, right? So it's taking them 109 days basically to sell their inventory. Okay. All right, inventory costing. So in a perpetual system, some of the costing information works a little bit differently. And so here's the information about the mountain bike inventory of trucking for the month of August. So it's the same number of units actually as we looked at several slides ago with the periodic system. But let's see what's different here. Nothing. So we still have 55 units, same as before, $5,990. We've sold 43 and we have 12 left in ending inventory. Okay, so we're going to use this slide to look at some of the next examples of costing. All right, so inventory costing in a perpetual system. So when identical items are purchased at different costs, we have to determine which amounts to record in cost of goods sold and which amounts remain in ending inventory. So the cost flow assumption, like we said before, does not need to follow the actual physical flow. So specific identification in a perpetual system is no different than in a periodic system. So you track each specific item of inventory, what it costs you, and then when you sell that specific item, you release those costs through cost of goods sold. So this example is the exact same as the periodic system. We sold 8 units that cost us 91, 12 units that cost us 106, so that's a 2,000. 2 at 91, 3 at 106, 15 at 115, and 3 at 119. So that's 2,592 of cost of goods sold. Add up those, you get 4,582 of cost of goods sold, which means your ending inventory must be 1,408. Okay. So first in, first out under a perpetual system, the oldest cost go to your cost of goods sold, and the recent costs stay in your ending inventory, right? All right, so in the first in, first out method on the perpetual system, basically all of our costs and activity are evaluated or recorded or calculated as it's happening. So the beginning balance, we have 10 units at $91 or 910 bucks. Then we buy 15 at 106. So now we've got that 10 at 91, the 15 we bought at 106 for a total of 2,500 bucks. Then we sell 20 units, and if we're selling first in, first out method, we're selling our 10 from our beginning inventory, and then we're selling 10 of the 15 that we purchased on August 3rd for a total of 1,970. So what remains is the 5 left from the August 3rd purchase at 106 or $530. Then we purchased 20 on August 17th at 115, so we have our 5 at 106. We have our new purchase, 20 at 115 for a total of 2,830. Then we buy 10 more on August 28th, so we have our 5 at 106, our 20 at 115, and then our 10 that we purchased on August 28th. Then we sell another 23 bikes. So the first in, first out, we're going to sell our 5 back from our August 3rd purchase, what's left over. Then we're going to sell 18 of our 20 from our August 17th purchase at 115, a cost of 115. So our cost of goods sold is 2,600. Then we have 2 left. We have 2 left at the 115 because we sold 18 of the 20. We have 10 left from our August 28th purchase. We haven't sold any of those. And so 2 times 115 plus 10 times 119 give us ending inventory of 1,420. Our total cost of goods sold, 1,970 plus 2,600, 4,570. So our last in, first out under a perpetual system, our recent costs are the first to hit cost of goods sold, and our oldest costs are in ending. All right, so under the last in, first out method, we've got our 10 units that we started with at 91. We buy another 15 at 106. Then we sell on August 14th. We sell 15 at 106 because that's the most recent from August 3rd. And then the other 5 come out of our ending inventory at 91. Okay. So then we're left with 5 from our beginning inventory. That's our oldest cost. Then we purchase 20. Then we have our 5 and our 20, and we purchase another 10. And then we sell 23. So we're going to sell the most recent ones, which is we're going to sell all 10 at $119 first, because that's from August 28th. And then we're going to sell the other 13 from the one previous, which is this guy. So we're going to sell 13 of our 20 at $115 for a total cost of goods sold of $2,685 plus $2,045 for $4,730. So the difference between the perpetual method and the periodic method is the perpetual method, when you make that sale on August 14th, we're picking up the most recent before the sale date. Under the perpetual method, or under the periodic method, you get all the way through the month, and at the end of the period, you value it. And so at the end of the period, you're taking into consideration all of the purchases for the month, not just the purchases immediately preceding the sale date. Does that make sense? I hope. Okay. And then our ending inventory is this 1,260, which includes 5 from your beginning inventory still, and you have 7 left from this 115 purchase right here, because we only sold 13 of those. Okay. All right, and then the weighted average under the perpetual method, when a unit's sold, the average cost of each unit in inventory is assigned cost of goods sold. So you take cost of goods available for sale divided by the units on hand at the date of the sale. So we go back to our example, our August 14th sale of 20 units. The way that we compute that cost is we say, all right before the date of the sale, I had 10 units at 91 and 15 at 106. So I had 2,500 units divided by, or $2,500, or 100 per unit. So if I take 25 units divided by $2,500, or $2,500 divided by 25 units rather, you get this $100 per unit. So when you sell the goods on the 14th, you're selling 20 of them at the $100 average price. And then what remains in your ending inventory is the other 5 at $100 per unit as well. Oh, okay, here you go. So on August 14th, 20 bikes are sold. So we take $2,500 divided by 25 bikes first to get the cost per unit, and then you multiply it by the units sold. Okay. All right, so then if we look at the second sale, what are they trying to say? So the August 17th sale, the cost of goods available for sale was $2,800. I had 25 units at that time, so my weighted average cost per unit for my August 17th sale, or the sale immediately following my August 17th purchase, is going to be $112 per unit. So there's 5 units totaling $500. On August 17th, 20 are purchased. So 2,300 plus 5 equals 2,800. Divided by $25 equals, or divided by 25 units equals $112 per unit. All right, so the weighted average perpetual part 3. So on August 28th, I've purchased another 10 units. So now I've got 35 units at a cost of $3,990. So my average cost is now up to $114 per unit. So after our August 28th purchase, there's 35 units, totaling $3,990, or $114 per unit. Then, if I'm computing the cost of goods sold for the August 30th sale, I'm going to take my 23 units times my $114 per unit, which is what I calculated the average cost to be after my 28th purchase. So if I take 23 units sold times the 114 weighted average per, I'm going to have cost of goods sold of $2,622. And then my ending inventory is going to be the 12 units that remain times that same $114 per unit. All right, and so all this slide is trying to show, I think, is the summary of all the activity for the month of August. So we started with 10 units at 91, so that's an average of $91 per unit. So we have 10 at 91. We bought 15 at 106, so 25, 10 times 91 plus 15 times 106 equals $2,500. Divided by 25 units is $100 per. So then I sold 20 at that $100. So now I have 5 left at $100, right? Then I have my 5 at $100. I bought 20 more at 115. So I have $2,800 divided by 25 units is 112 per unit. So then now I've got my 112 per unit plus I bought 10 at 119. So 25 times 112 plus 10 times 119 is $3,990. And I've got 35 units now, so that's 114 per unit. And then I've got 114 per unit less the 23 I sell at 114 per unit. And then I'm left with the 12 at 114, or ending inventory of 1,368. Then if you add up all of your individual cost of goods sold, we have cost of goods sold of 4,622. All right, so the financial statement effects of inventory costing methods. Under the perpetual method, because prices change, inventory methods, nearly always assign different cost amounts. And so I think all they're trying to tell us here, basically we begin under the specific identification method. We have cost of goods sold of 4,582. Under the FIFO method, cost of goods sold of 5,070, LIFO 4,730, and weighted average 4,622. So really, they're not significantly different. But you can see that the LIFO method results in the least amount of net income. The FIFO method results in the most amount of net income, and also the highest inventory on your balance sheet, whereas LIFO assigns the lowest cost inventory to your balance sheet. So let's see if there's anything else important here. That's about it. So it's really just showing you the comparison of the different methods and what happens to your cost of goods sold, net income, and inventory. All right, so the company reported the following December purchases and sales for its only product. They used perpetual inventory system to determine the cost assigned to the ending inventory and the cost of goods sold using the 4 methods. So they tell us that ending inventory consists of 10 units and that 8 are from December 30 and 2 are from December 8th. So no matter what method we use, we have 26 units in cost of goods sold and 10 in ending inventory. All right, so under the specific identification method, it's not going to matter. Actual cost of goods sold represent actual cost of units selected by the customer. And ending inventory represents the actual cost of units that remain in ending inventory. All right, so under specific identification, they tell us that 8 are from December 30th and 2 are from December 8th. So our 2 from December 8th at $450 each, plus our 8, that's what's in our ending inventory. Everything else is in our cost of goods sold. Okay, so that's no different than the periodic system. So we have cost of goods sold of 116, ending inventory of 5140, and goods available for sale of 166. Under the perpetual FIFO method, cost of goods sold is calculated at the time of the sale. First items in or first items out, expense to cost of goods sold. So December 1st, we have 5 at $3 each, or 15. Then we purchase 10 at $450. And we still have our 5 from our beginning. So now we have $60 in inventory. So now we sell 8 units. So we're going to sell the 5 from our beginning inventory and then 3 from our purchase of 10. We have 7 left from our purchase of 10. Then we're going to buy 13 at $5. So we have our 7 left plus our 13 at $5. Then we're going to sell 18. So we're going to sell, we've got 7 left from our December 8th purchase. So we're going to sell those at $4.50 first. And then we're going to sell 11 of our 13 purchase at $5. So now we have 2 left at $5. And then we have our December 8th or December 30th purchase of 8 at $5.30. So we have our 2 left plus our 8 purchase for ending inventory of $52.40. Cost of goods sold is our $28.50 plus $86.50 or $115. Right, under the perpetual or LIFO method, again, we're calculating cost of goods sold at the time of the sale. Last items in are first to be expensed. So we have our 5 at $3. We bought 10 at $4.50, so we have our 5 at 3, our 10 at $4.50. Then we sold 8. So the 8 we're going to sell are going to be from this $10 purchase, right? So they're at $4.50. So we have our 5 at $3 left, plus our 2 at $4.50 for a total of $24. Then we purchased 13. So we've got our 5 at $3 left, our 2 at $4.50 left. We purchased 13 at $5, so we have $89. Then we sell, how many units? 18 units. So the 18 that we're going to sell, you're going to sell all 13 from the December 19th purchase because that was the latest. Then you're going to sell the remaining 2 from our December 8th purchase. And then we're going to sell the last 3 for our total of 18 from the 5 that we had in our beginning inventory. So then what we're left with is our 2 from beginning inventory, this one right here. So we have the 2 from beginning inventory. We purchased 8 at $5.30, so we have $48.40 left in our ending inventory. We have 119 in our cost of goods sold. That's our 36 plus our 83 for 119. All right, under weighted average, we have 5 at $3 to start. Then we purchased 10, so we have 5 at 3 and 10 at $4.50. It's a total of 60 units divided by, or a total of $60 divided by 15 units, or $4 average cost. So when we sell our 8 on December 9th, we're using our average cost of $4, which means we have, let's see, 7 left, right? We had 15, we sold 8, we have 7 left at that $4 cost. Then we purchased 13, so now we have 7 at $4, 3 at $5 for a total cost of 93. We have 20 units, so 93 divided by 20 is $4.65. So when we sell our 18 units on December 24th, we're going to sell them at our average cost of $4.65. And then we have, let's see, we had 20, we sold 18, so now we have 2 left at that $4.65. And then we purchased 8 units on December 30th, so we have 2 at $4.65, 8 at $5.30 for a total of $51.70 divided by 10 units, or an average cost of $5.17. Our total cost of goods sold is our 32 plus our 83 for a total of $115. All right, so we are going to stop there. Appendix B, I don't believe that you are going to see on the exam. So if you have any questions about this chapter, it's probably the last one that's really difficult, and then it starts to get a little bit easier from here. Inventory is kind of a tough one. And it's also something that I don't have a ton of experience with in real life, so it makes it a little bit harder for me to teach as well. So if there's something that is not clear, um, please don't hesitate to reach out and I'd be happy to help. So I hope that you find this PowerPoint helpful, and if you need clarification on anything, please don't hesitate to ask. Take care.